Hello students, this transmission is from Pharma College, Department of Accounting and Management. Name of the course is Fundamentals of Accounting 2 for first year Accounting and Management students. Instructor Dagnat. The course contains 5 chapters. Each chapters have their own objectives. When we come to the first chapter contains accounting for inventories. When we come to introduction, in the last section of fundamentals of accounting 1, you have learned about the principles and practice of accounting for receivables. So this is one of the current asset items in the balance sheet of a retail business. In this unit, you will learn and discuss about the concepts in accounting for inventories. Actually, inventories are asset items held for sale in the ordinary course of business, or goods that will be used or consumed in the production of goods to be sold. Inventories are mainly divided into 2 major categories. The first one is inventories of merchandising business. They are merchandise purchased for resale in the normal course of business. Those types of inventories are commonly known as merchandise inventories. The second category of inventory is inventories of manufacturing business. They are businesses that produce physical outputs. They normally have 3 types of inventories. This is common types of inventories. The first one is raw material inventory. This raw material inventory is the cost assigned to goods and materials on hand but not yet placed into production. This includes the wood to make a chair or other office furniture, and as well as the steel to make a car. They are commonly known as raw material inventories. The second type of inventory is work in process inventories. This is the cost of raw material on which production has been started but not completed. The third type of inventory is finished goods inventory. This is the cost of inventories that identified with the completed but unsold units of hand at the end of each period. They are completely finished goods. When we come to the importance of inventories or advantage, merchandise purchased and sold is the most active elements in merchandising business. That means in wholesale and retail type of business. This is due to the following reasons. The first reason is the sale of merchandise is the principal source of revenue for them or for business organizations. The second reason is the cost of merchandise sold is the largest deduction from sales. And the third reason is inventories or ending inventories are the largest of the current asset or those firms. Here, because of the above reasons, inventories have their own effects on the current assets and the following or the next period's financial statements. If inventories are misstated or understated overstated, the financial statement will be disclosed. When we come to the internal control over inventory, here, students, as we have seen in Fundamentals of Accounting 1 about internal control over cash, likewise, internal control over inventory is needed. Inventories affect both the balance sheet and income statements. In balance sheets, inventory is frequently the most significant part of current asset. In the income statement, inventory is vital in determining the result of operation of a particular period. Therefore, good internal control over inventory must be maintained for two primary objectives. The first objective is that inventories can be maintained to safeguarding the inventory and as well as properly reporting it in the financial statements. Here, control over inventory should begin as soon as the inventory is received. When the inventories are received, immediately controlling system will be what began. A receiving report should be completed by the company's receiving department in order to establish initial accountability for the inventory of the business. The next point is about inventory costing methods. To cost the inventory or to identify the cost of inventory, there are two main common principal systems are presented. The first one is periodic inventory system. The periodic inventory system, or under this system, there is no continuous record of merchandise inventory account. The inventory balance remains the same. And also the accounting period will be what throughout the balance is the same. That means the beginning inventory balance will be the same. This is because when goods are purchased, they are debited to the purchase account rather than merchandise inventory account. So such kind of system which is known as periodic. The next inventory costing method is perpetual inventory system. Under this system, the accounting record continuously discloses the amount of inventory so that the inventory balance will not remain the same. So this is the difference between perpetual inventory system and periodic inventory systems. All increases are debited to merchandise inventory account and all decreases are specially credited to the same account. Therefore, no purchase and purchase returns and as well as allowances accounts in this system. At the time of the sale, the cost of goods sold is recorded in addition to journal entry for the sale. The next point is about inventory cost flow assumptions. Inventory cost flow assumptions is one of the most important decisions in accounting for inventories is determining per unit costs assigned to inventory items. Each inventory costs will be assigned by using the inventory cost flow assumptions. There are four main methods are commonly used in this inventory cost flow assumptions. Those are specific identification method or assumption, first in, first out or FIFO assumptions method, last in, first out or LIFO method, and weighted average determines cost of merchandise sold and inventory at the end of the period. Those four assumptions are very important to assume and assign each per unit costs of the inventory. How we assign those costs to inventory and cost of merchandise sold affects the reported amount for both systems. Here, dear learners, there is an example is presented below. Example 1. Let us see those costing methods under periodic inventory system based on the following illustrations. Given, a smart company began the year and purchased merchandise as follows. Take a moment and consider the following given. This company assigns costs for each units here. For each units, costs are assigned. Each unit's cost will be what presented here. The total unit is present here. Total costs will be presented here for those 5 months. Ladies and gentlemen, when we come to example 2 about specific identification method, here from the above illustration, the ending inventory consists of 300 units and 100 from each of the last purchase. So the items on hand are specially known from which purchase they are. Cost of ending inventories under a specific identification method is calculated below. Each units of inventories are present. Each units of cost will be what presented. Those total units of inventory is here 300 units, and total costs for those 300 units will be 13,600. Here, cost of ending inventory. The cost of ending inventory is equal to 13,600. The cost of merchandise sold is equal to cost of goods available for sale minus ending inventories. Cost of ending inventory is 13,600 and cost of goods available for sale is 59,520. Here minus 13,000